So right now, if you look at India into two part, so we look India in two part, micro India and macro India. Uh, what do you mean by micro India? Micro India is nothing but the individual balance sheets and corporate balance sheet, and macro India is the government of India balance sheet. Right now, as I speak, micro India is in very strong health. No signs of stress anywhere. As such, all the stress has been borne by the macro India. Micro India, if you look at banking system, loan growth continues to remain very strong. The data for April, May are still indicating strong loan growth demand. If you look at banking systems, NPA remains very low. And most importantly, the unsecured part of the banking system, which are nothing but the credit card, personal loan, microfinance, and micro lending, which is micro lab, all showing signs of stable asset quality. Incrementally, banking is the only sector in India where data availability has increased tremendously. So, right from credit bureau, you have all data in terms of how asset quality, how 0 to 30-day DPD movement behaves. 0 to 30 day means anyone who has defaulted or in the loan repayment in 0 to 30 days. All are showing very good thing. Recently, a fintech got listed called Kisht. They are nothing in, they are into a small personal loan segment, which are personal loan between 30 to a lakh rupee. If you look at their Q4 result and the presentation and the con call, you could see a lot of data points which indicate that even the small ticket personal loan segment is doing great in India, which gives comfort that micro India is doing very well. And similarly is the case with macro India, with corporate India. Both are showing good balance sheet, good liquidity, everything. So micro India is into strong health. And if you look at before this Middle East war crisis also, government has been focusing a lot more inwardly in terms of, as India could not have a deal with US, or a deal with US was taking a little longer time, government started focusing on inwardly, started looking at capex in India, started looking at consumption spending in India, and therefore you could see last budget they had very decent fine balance between capex and consumption. India's capital expenditure, government capital expenditure has increased from 2% of GDP to 3% and now has stabilized. More importantly, the absolute amount of capex done by government, state government, private today is somewhere into 30-35 crore rupee, lakh crore rupee per annum. And this can grow in line with the nominal GDP. Large base growing at 10%, it's also positive. And similarly, government has started focusing on even on consumption. If you look at all state government to win election has started announcing freebies. Second, GST cut benefit, income tax benefit, all which means that consumption growth will remain likely to remain strong in India. Strong in India. The GST cut benefit has been seen in auto sector. Would now we believe it could be seen in even in consumer sectors, staples to benefit from that. Different state government in different elections has announced various freebies. So in the left hand corner, you can see that various state government has announced, and today that cumulatively is 3 lakh crore rupee, which means 3 lakh crore rupee per annum will be disbursed into the bottom of the pyramid. See, post COVID, what has happened in India is that equity market had rallied very strong. And if you could see, everyone who has invested in India has made a lot of money. Equities have done very well, gold and silver have done very well, real estate have done very well. So rich has become richer in India, and therefore income inequality has widened. And which is why you could see various state government to win election has started announcing various bonanza for the bottom of the pyramid. The pain in the bottom of the pyramid was seen in the microfinance cycle. 4 quarter back, they were huge NPA in the microfinance side. Now everything is recovering. So as I indicated earlier, that micro India is too strong because all the worst of NPA is behind. Credit disbursement in the microfinance has started. State government has started announcing various freebies. GST has been cut. So India, if you look at before all this Middle East crisis, was into a very strong hand, and FY 27 and 28 earning growth was expected to be very strong. So what has happened in last 3 months? Suddenly, what has changed? See, it, India remains vulnerable to energy shock. As a country, we import a lot of oil. We import a lot of LPG and natural gas. So any crisis in the Middle East has impacted us. So one thing, oil has gone up and that has impacted our fiscal deficit, likely to have impact on our fiscal deficit, and how much. And so, just as a thumb rule, if you look at every $1 increase in oil prices, India needs to increase fuel prices by 60 paisa. Every 1 rupee depreciation in currency, you need to increase your fuel prices by 30 paisa. And if you look at, oil has moved from 70 to $100, which means $30 increase in oil prices into 60 paisa, 18 rupee is the oil price increase. And currency impact is another 3 4 rupee. So we need to increase fuel prices by 22 rupee to pass on to this. So far, government has cut excise duty by 10 rupee and increased the fuel price by 7.5 rupee. A large part of the scheme has already been passed. I think we are still losing at 4 to 5 rupee at currently, despite this rise hike. See, so what the government of India taking? See, government of India today is struggling with twin challenges. One challenge is that FII continue to continue to remain a seller in India, which is impacting our FX. So currency is getting depreciated. Second, FDI, which used to be a lot of positive for India, has now started getting impacted. And third, added to that is the oil shock. See, India biggest challenge is India is a service economy, and when we are a service economy means we don't have a pricing power, and therefore any external challenges impacts India much more. Second, India's biggest strength is its manpower. India is the largest exporter of manpower. Look at IT industry, look at any other industry. So for us, important is globally, if there is a peace, India would do very well. If there is uncertainty, macro uncertainty globally, India would get impacted. So right now, there are multiple challenges to the government, and I'll explain you what are long-term challenges and what are short-term challenges. The near-term challenge for government of India is currency depreciation and impact of Middle East crisis. The 7.5 rupee fuel price increase to an extent address the challenges on the fuel side. And I think even if the Middle East crisis settles down, oil will come down to $85. I believe government will not cut the fuel price then and will hold on to the 7.5 rupee increase so that they are able to recover the shortfall as well as also the 10 rupee excise benefit they have given to us. Then the second challenge for India is the currency depreciation. Say India in general is an import dependent country. Our imports are always higher than export. And therefore, how do you fund this? We fund our CAD through either remittances, right? And also through FDI and FII. At this moment of time, if you look at the challenges of the CAD has always been negative and it's been in the range of 4% negative to 1%. So we are at 1% negative. The real challenge is we are not getting FII flows and FDI. How do you balance your CAD or current account deficit is or your funding of that comes from your FII, FDI investment and FII investment. So while you could have heard in various news articles that FDI investment in India is now turning negative. So what it mean that? See, we get foreign gross FDI investment in India is still positive, is around 80 to 90 billion dollar. What is negating that is the net FDI. So we have $90 billion of gross FDI. Indian investing abroad or Indian corporate investing abroad and FDI taking money out. What do you mean by FDI taking money out? Is that any company get listed, you could see a lot of selling by PE guys, which is nothing but that money is being moved out of India. Some of the corporate got listed, example could be in LG and Hyundai, they got listed, they had taken that money out. So FDI has moved out. So FDI movement out in last 2 years has been quite significant. One of the reason could be Indian market debt has increased and which resulted in lot many companies raising equity, lot of PE guys selling equities, and therefore FDI has become negative. So your net FDI has become negative, and which is what is impacting the currency. Is there a solution to this? So historically, whenever we had challenges, either we have gone to raise ECB, we have gone and raise bond borrowing overseas market. This time it is unique because interest rate globally are higher, hedging cost has gone up higher. So if we have to raise dollar by overseas, it will cost us between 8 to 10%, which is really very ineffective given where the interest rates are in the domestic. So that is one challenge. Second, if oil prices remains very high for a little longer time, then we would have challenge of high inflations. So government is into catch 22 situation. The way to look to stop currency depreciation, one way is to do overseas borrowing or to raise interest rate in the economy. If we raise interest rate by 100 basis point at this moment of time, the economy is into a recovery shape, and if we raise interest sharply, it will impact the growth. So ideal way for the government is to look at ways and how you can manage it. See, the near term challenges will have some near term impact will have some challenges on the economy, but I think government, I believe, is are looking into medium term to long term, and all the measure they are taking is towards that. So what India is doing? India is looking at focusing on manufacturing. India has announced various PLI schemes so that we go into so manufacturing comes to India. So the biggest challenge is if you are a product country, then you have pricing power. If you are a service country, then you don't have a pricing power. So India is moving towards manufacturing. India's manufacturing contribution to GDP is one of the lowest. If that were to increase, then it will provide a lot more stability to FII and to also to currencies. And towards that, India is doing. And this recent Middle East crisis is a blessing in disguise for India. While everyone will say no, it is negative for India, but I believe it is a blessing in disguise. Is the recent fact that now government of India will start focusing on taking measures to control the energy crisis. India would start moving to EV acceleration penetration will start increasing, will become more and more faster. Government of India has announced a project on coal gasification. This project was thought 12 year back, but it couldn't conceptualize because of ESG impact and lot many things. Now with energy crisis, now we are moving to a coal gasification. This will result in gas availability, and therefore our fertilizer import can be managed. See, China doesn't have so much of challenge. See, today natural gas availability is a challenge for everyone, but still China has been able to manage because they do a lot of coal gasification. Now India is moving into that direction. India has already started focusing on a lot of renewable energy, thermal. I think nuclear energy will get accelerated. So India is focusing on what we have surplus. So India had large amount of land, natural resources, sunlight, and rainfall. So we would be looking to become energy surplus country. We would move to thermal, we will move to solar, we will move to renewables, we will move to nuclear. That will address help to our power demand and will become power surplus company. One challenge India has today is solar. We are doing great in solar, but solar power gets generated in the afternoon and demand comes to India being either in the morning or in the night. So what we are doing, we are focusing on energy storage, which is battery. But the challenge with India is India today also import a large amount of batteries from China. Why we import large amount of batteries? Because China has overcapacity. Second, we never thought we will have so much of demand of batteries. To support that, government has announced a PLI in battery, and now we are in next 3 to 5 years we will also become self-sufficient in batteries. So, so the near-term challenges are being addressed in such a manner that this become a very strong foundation. Improve manufacturing, look at energy security, and that will address. While FII or FDI flow are unlikely to change in the near term. Why it will not change in the near term is the fact that look at companies. We have few companies like Grow, Lenskart, which all got listed very recently. All these companies are majorly owned by PE guys. So at some point of time, all these PE guys would like to exit, and therefore we will have more of FDI going out of the country. We could have a large pipeline of IPO, right, from SBI mutual fund to Geo to PhonePe, all are looking to get listed. In each of these companies, the FII or FDI proportion is higher. Like for example, if Geo get listed, 33% of the Geo is being owned by Google, Meta, and various PE funds. All this PE fund at some point of time would like to exit. If suppose Geo gets listed and trades at $150 billion, a 33% means $50 billion outflow. So challenge for India could be FII, FDI money are unlikely to turn positive in a big way. So we need to, and how can we address this shortfall is improve our manufacturing. So one can say that currency depreciation to an extent would benefit India in terms of improving our export competitiveness vis-a-vis China, and that would drive some exports. See, last year when tariff talks with US has not fructified, India's export got impacted, textile and other auto ancillary, gems and jewelry. But now with trade deal being talked out, India could get a lower duty structure, currency got appreciated. We believe this year we should see a lot of benefit in terms of export. More importantly, India had done trade deal with Europe, Japan, Australia, and a likely deal in the pipeline with US. This covers approximately 80% of the global world trade, and that will help us to manage. With 80% of the global trade being, we have a trade deal, it means a lot of supply chain investment will start happening in India, and that will start getting. And in a medium term, if you look at 3-year view or 5-year view, we would become much more stronger economy. We would move from a service oriented economy to a very balanced economy in terms of manufacturing getting improvement through various PLI schemes. Second, our energy dependence will come down to an extent, and in that context, things will start stabilizing for India. Third most important thing, see, if you look at all developed country in the world, like all R&D happens in developed country and India lacks in the R&D. And this has been a very common complaint that India doesn't do spend on R&D. The table on the right hand side clearly shows that India's R&D spend as a percent of GDP is quite low. One of the reason is also low because India was a low per capita income, and corporate India were not in size and scale, and therefore they were all more focused on ROE and profitability. Large corporates in India are gaining into scale and size, and now they can start spending on R&D. This 0.7% can easily become 1.2% of GDP, and you could see benefit of that coming up. This 0.7% is a FY25 data because this data comes with a lag. But if you go back and look at FY20, FY15 data also, the R&D spend has been in the range of 0.6, 0.7%. But in that period of time, our GDP has more than double, and therefore R&D spend in absolute amount has doubled. But as this increases, this happen. Like I said, ki in one generation in a country has to earn, then only the second generation can live. So after a very long time in India, there's a wealth effect. There has been a wealth effect across HNIs and corporates, and therefore I think balance sheets of individuals are very strong. And you could see a lot more individual HNI now are investing in startups, ready to and capital is available. Equity markets have got mature. Today, even a mutual fund industry is public market are ready to fund a loss-making enterprises. Like example could be the quick commerce, and which gives a lot of confidence that maturity has happened, and therefore R&D as a spend will keep improving, and India is moving in the right direction. So I explained a lot of positive, negative, but despite all the challenges, see if you look at decadal growth of India, despite all the challenge, we have been able to grow at 6 to 7% with inflation at 4%. So nominal GDP has been growing at 10, 11%. If you look at long term also, if you look at Nifty EPS growth and India's nominal GDP growth, the returns on Nifty are very similar to the nominal GDP growth. What we do in value fund, I'll just come directly on the point. Ki what we do on the value fund. See, everyone thinks ki how do you define value? Value का vague definition होता है buying stocks at cheap valuation, right? But our value fund has a very clear cut definition. What it says that 60% of the stock will be such in the portfolio which will be have a PE or price to book value lower than the last 5-year average, and 40% of the portfolio can be anything. This is the definition given in the offer document. How we look at value fund. See, we categorize value into three categories: absolute value, turnaround company, and relative valuation. So, what are absolute values? Absolute values are company which are trading closer to the intrinsic value. So, as I speak, some of the oil marketing companies today are trading at replacement cost or a 1x price to book value. These are absolute value company where we believe the downside is very limited, because we still believe the Middle East crisis will end at 1 month or 2 month time, and oil will come back to 75 to $80, and you could make. So these are examples of absolute value. Some of the utilities companies are absolute value, and as I speak today, even the large private sector banks have become absolute value companies. They all are trading at 10 to 11 P multiple. Second are relative valuation. So how do we define relative valuation? See, relative valuation could be consumer staple companies which are trading at cheaper valuation to the historical, or in the past they were trading at 55 to 60 P multiple. Today they trade at 40 P multiple. So they become relatively cheaper, and that's why they are relatively attractive. And last category is a turnaround company. See, this is the key, the portfolio. See, this is a turnaround company are one where we look at companies where there could be some challenges in the near term in terms of capital allocation, in terms of margin, in terms of change of promoter or change of management, which means businesses have temporary challenges. These are the company where we invest. Typically, we look at 25 to 30 bottom of ideas and in terms of turnaround and invest between 50 basis point to 150 basis point of the portfolio. And this is where we invest. See, last 5 years or last 3 years, we have seen multiple IPOs in India, and which is why India markets have become a little more discovered market. To find true value in India has become a little difficult because as more and more company gets relative valuation become more and more key. As more company get listed, the premium valuation comes down. Similar is the example in the past when Grow Housing Finance was listed, it used to trade at 10x P multiple. Today you have 7, 8 affordable housing finance company listed, all are trading between 1.5 to 1.8 time P multiple. Reason being, despite 20% loan growth, they are trading at low multiple is number of company got more listed, capital or money got distributed among idea. Same is the case with hospital, same is the case with pharma, same is the case with diagnostic, and this has happened in multiple sectors. So for then what matters is now relative valuations, and India now has been started trading at attractive valuation in terms of relative. This is India's premium over emerging market. This has declined significantly. Last year we underperformed very to emerging market very significantly. Even FY26 Y2D, India is underperforming. Second, look at India's market cap. To India's market cap share to world market cap, that has declined from 4.7% peak to 3%. Our GDP market share is also at 3.3. See, if you had seen this chart presentation 6 months back, then this 3.3% of India's contribution to world GDP would have been 3.5, 3.6%. But our currency got appreciated by 10% and GDP is measured in dollar terms. This has come down. So relatively, our valuation has now started become attractive, and which is why we believe this will you could see earning growth from here on improving. India valuation is supportive. Relative valuation we have corrected very significantly compared to other market, and India being an domestic economy, service economy, impact to us should be limited. uh, So everyone would have a question ki, where do you think what will happen? See, if you look at Nifty's last 2 year performance has been bad. One of the reason has been the earning growth. FY25 Nifty EPS earning growth was 2%. FY26 it ended with 6% earning growth. So last 2 year earning growth was muted, and which is why you could see muted returns. And add to that with number of IPOs coming up, supply of stock, all impacted the valuation. Today, as I speak, the earning growth expectation, this is Bloomberg consensus estimate for FY27 is 17%, for FY28 is 14%. Now the next question will happen here, what will happen because of the oil price remain very high, inflation very high, WPI inflation has gone up, and suppose oil remains at $90, $95 for a little more time than we expected, this 17% earning growth can come down to 10 to 11% earning growth. So today, as I speak, Nifty earning growth, Nifty EPS is 1070 for FY26. Assuming a 6% earning growth worst case for FY27 and a 15% earning growth in FY28 as the base gets set in, Nifty EPS comes to 1300 rupee. So in a worst case, if Nifty trades at 15p, 16p multiple, so market should bottom at 21,000 level. If Nifty goes back to the historical level of 20p multiple, market should go back to 26,000 level. So at 23,000 level, the risk reward is very balanced. Any correction in the market would be a very good opportunity to invest to further increase the allocation. See, in my earlier, I said micro India is doing great. So there is no challenges on the micro India side. And therefore, if oil prices were to settle down, we would continue to see a 14-15% earning growth. Second most important thing to say that, see, our markets have been well discovered. Relative valuation is key for now investment, and that is what we say ki rather than a diverse, no, rather than every stock going up, now it's become a very stock specific market. You The focus of the market on corporate earnings will be very high, and companies disappointing on the earnings side will get stock correction very severely, and which is why we look at our value fund where I just explained what are turnaround companies and how we invest in those turnaround companies, and we do uh, this is what I explain you. Okay, in terms of absolute value companies, which are 32% of the portfolio, relative valuation companies, which are 36% of the portfolio, and turnaround companies. And I'd also given the EPS growth estimate. One common question everyone would have is that what is the P multiple of the portfolio? See, today as I speak, the P multiple of the portfolio is 23 times on FY28 earnings. And if I had to look at earning growth, right, for different, like for turnaround companies 22%, for relative valuation it is 16%, and for absolute valuation it is 9.5%. This 9.5% for absolute value company could be around 11 to 12%, because this has some of the oil marketing companies which have seen very good FY26 and would see a bad FY27 and a relatively stable FY28, because very difficult to predict oil prices at this point of time, and that's why this is earnings are expecting a degrowth in those oil marketing company. That's why the EPS growth is 9.5%. Relative valuation companies are very stable company. A lot of consumer stable company being part of this. Auto ancillaries, pharma are part of this, and they are all expecting a 16-17% earning growth. And the turnaround companies, we are expecting a very sharp earning growth of 22%. This is the portfolio allocation in the value fund. This is the performance of the value fund. Despite various fund manager managing fund, every time the fund has delivered better than the benchmark. It's only the fact that the stock selection and the process it followed has been very stable, has been true to mandate across all time period of time. And which is why it has given very consistent return across all time period. See, when we build a portfolio, we typically look at a portfolio of stocks from a 3-year perspective. But we look at the stock very closely and believe that if the company start delivering or in the right direction for 6 quarters, will continue to own it. If we do not find that a company delivering as per our expectation, or at least the direction is not our expectation, we would be looking to churn the portfolio. Generally, investment horizon is 3 year, but we monitor the company very closely for 6 quarters, and based on that, we build the portfolio. This is what is the overweight, underweight position in the portfolio. Financials are overweight, real estate are overweight, utilities are overweight. Performance of the portfolio. So these are the top holdings of the portfolio. I've been working with HDFC for last 20 years, and I've been a banking analyst all throughout, uh, and managing the banking fund for the last 5 years. How do we manage the banking fund? See, our focus has been very clearly on companies where we see earning growth. I had dissect on the right hand side of the table. I dissect the BFSI sector in very detail, given large PSU banks, large private sector bank, large NBFCs, mid-sized bank, and given the FY24 to 26 earning and FY26 to 28 Bloomberg consensus earning estimate. And based on that only, we had constructed our BFSI portfolio very bottom up. We are underweight on PSU because we expect a part earning consolidation to happen in PSU bank. We have seen large private sector bank losing market share. Now they are coming back, looking at gaining market share, and we believe the 125 basis repo rate cut has been fully now been in the numbers in terms of passing on. And from here on, we see large private sector bank doing earning growth better than the PSU bank. We have given large NBFCs also where we are overweight. We are saying okay, NBFC as a sector will continue to grow faster than banks. We had been looking at all turnaround companies or companies where we either because of NPS cycle getting over, either because of margin getting improved, either because of provision costs coming down, and you could see improvement in earning in each of these them, and which is why the BFSI fund has been positioned very significantly. Capital market businesses has a very strong FY24 to 26, but I believe the base is very high in some of these companies in the sector. Therefore, you could see earning consolidation in this sector. Where we had been there, we had looked at multiple companies in this sector, and wherever we feel the earning growth can sustain at 25 to 30%, we are looking to invest in those companies. This has been the performance of the banking fund. This June end, this fund will complete 5 year, and I believe since inception also this fund would have been beaten the benchmark. Uh, these are the rolling returns of the fund, and these are the top holding of the fund.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.